There's a detail about silver that most investors are completely missing right now. And I don't say that lightly. In all my years analyzing precious metals markets, I've learned that the most profound opportunities and risks don't announce themselves with fanfare. They emerge quietly in the data, in the supply chains, in the structural shifts that most people simply aren't watching. Right now, we're witnessing one of those moments. This isn't about price predictions. It's not about promising you overnight wealth or creating fear where none should exist. This is about understanding a fundamental shift that's occurring in the silver market. A shift that could have serious implications for anyone who holds this metal, anyone considering it, and anyone who cares about preserving their purchasing power in an increasingly uncertain world. The detail I'm referring to isn't secret. It's hiding in plain sight, buried beneath headlines about gold, obscured by more dramatic market movements, overlooked by the majority of financial media. But here's what you need to understand from the very beginning of this conversation. Silver has always occupied a unique position. It's not quite a pure monetary metal like gold. It's not quite an industrial commodity like copper. It exists in both worlds simultaneously, and that dual nature creates dynamics that are utterly unlike anything else in the financial markets. Today, we're going to examine this metal with clear eyes and steady judgment. We're going to look at what's actually happening, what it means, and how to think about it rationally regardless of your current position. Because whether you own silver, whether you're considering it, or whether you've never given it serious thought, the structural changes unfolding right now deserve your attention. Let's begin. Before we can grasp what makes this moment different, we need to establish a foundation. Silver is fundamentally different from gold, and understanding that difference is critical. Gold is primarily a monetary asset. Yes, it has industrial uses, but roughly 90% of gold demand comes from investment and jewelry, stores of value, expressions of wealth, hedges against currency debasement. When you think about gold, you're thinking about money, about savings, about insurance. Silver is split down the middle. Roughly half of annual silver demand comes from industrial applications, solar panels, electronics, medical equipment, water purification, electric vehicles, 5G infrastructure. The list goes on and expands every year. The other half comes from investment demand, jewelry, and silverware. This creates a tension that doesn't exist with gold. Silver must serve two masters, the monetary world and the industrial world. And those two worlds don't always move in harmony. When industrial demand surges, it can overwhelm available supply even if investment demand remains modest. When investment demand awakens, it can create shortages even if industrial consumption stays constant. Now, ask yourself this question. What happens when both forms of demand accelerate simultaneously? That's the detail most people are missing. That's what's beginning to unfold right now. Let's talk about where silver comes from, because this matters enormously. Unlike gold, which is mined primarily from dedicated gold mines, the majority of silver production is actually a byproduct of mining other metals: zinc mines, lead mines, copper mines. These operations produce silver as a secondary output. Only about 30% of silver comes from primary silver mines. Think about what that means for supply elasticity. If silver prices double, a primary silver mining company can decide to ramp up production, open new deposits, extend existing operations. But the majority of silver supply doesn't respond to price signals the same way. A copper mine produces copper based on copper economics. The silver they extract as a byproduct is almost incidental to their decision-making. If copper demand weakens, that mine might reduce production even if silver prices are strong. This creates supply rigidity that most investors don't fully appreciate. Now, layer on another reality. Mine production of silver has been essentially flat for years. Despite advancing technology, despite higher prices at various points, global mine supply hasn't grown meaningfully since the mid-2010s. Meanwhile, demand has continued to climb, particularly from the industrial sector. For the past several years, the silver market has been in a supply deficit. More silver has been consumed than produced. The gap has been filled by above-ground inventories, recycled silver, existing stockpiles, investment holdings being liquidated. But here's where it gets interesting. Those above-ground inventories aren't infinite, and as industrial applications for silver continue to expand, and particularly in green energy technologies, the structural deficit appears to be widening, not narrowing. Ask yourself, how long can a market remain in deficit before something has to give? The solar panel revolution deserves your full attention. Silver has unique properties that make it virtually irreplaceable in photovoltaic cells. It's the most conductive metal on Earth. It's reflective, it's ductile. It doesn't corrode easily. Every solar panel uses silver. Not a trivial amount. Significant quantities go into each unit. Now consider the global push toward renewable energy. Every major economy has committed to massive solar installation targets over the next decade and beyond. China, Europe, the United States, India. The scale of planned solar deployment is staggering. The Silver Institute estimates that solar panel production alone could consume over 20% of annual silver supply within the next few years. That's one application, one industry, claiming a fifth of global supply. But solar is just the beginning. Electric vehicles use significantly more silver than traditional combustion engines. The electrification of transportation isn't a maybe, it's a when and how fast. 5G networks require substantially more silver than previous generation telecommunications infrastructure. The build-out is already underway globally. Medical applications for silver, particularly its antimicrobial properties, continue to expand. Water purification technologies increasingly rely on silver. Electronics become more sophisticated and more numerous every year. This isn't speculation. This is observable reality, playing out in manufacturing facilities and infrastructure projects worldwide. The industrial demand for silver isn't growing at 2 or 3% annually anymore. In many applications, it's accelerating at double-digit rates. And remember, this industrial demand is largely inelastic. A solar panel manufacturer can't simply decide to use half as much silver if prices rise. The technology requires what it requires. They either pay the price or they don't produce the panels. This is fundamentally different from investment demand, which can evaporate overnight if sentiment shifts. Industrial demand is sticky, persistent, structural. For years, silver investment demand has been relatively quiet. After the dramatic run-up in 2011, when silver briefly touched $50 an ounce, the metal entered a prolonged bear market. Prices declined. Sentiment soured. Many investors who bought at the top experienced painful losses and swore off the metal entirely. The investment world largely moved on to other narratives: cryptocurrencies, technology stocks, real estate, cannabis, whatever captured the moment's imagination. But here's what's shifting now. Macroeconomic conditions are reminding people why precious metals exist in the first place. Government debt levels across developed economies have reached peacetime records. Central banks maintain balance sheets that would have been unthinkable 2 decades ago. The printing presses that ran hot during the pandemic era created a fundamental shift in how people think about currency stability. Inflation, which many economists insisted was transitory or dead, proved to be neither. The purchasing power of major currencies has eroded noticeably. People feel it when they buy groceries, when they pay rent, when they fill their gas tanks. This creates an environment where hard assets begin to look attractive again. Gold has already reflected this shift, reaching new all-time highs, but silver has lagged dramatically. The gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, remains historically elevated. At various points in recent years, that ratio exceeded 80 to 1, even 90 to 1. Historical averages sit closer to 60 to 1. In periods of precious metals enthusiasm, the ratio has compressed to 30 to 1 or lower. What this means practically, silver is historically cheap relative to gold. Now, I want to be very clear here. Cheap doesn't automatically mean it's going higher. Markets can stay cheap or expensive for extended periods. Valuation is just one factor among many. But when you combine historical cheapness with structural supply deficits and accelerating industrial demand, you create a setup that deserves serious attention. Investment demand for silver doesn't need to reach 2011 levels to impact prices significantly. Even a modest reawakening of interest, when combined with already tight supply conditions, could create substantial moves. And there are signs that reawakening is beginning. Let's talk about what's happening in the monetary realm, because it connects directly to precious metals. Central banks globally have been net buyers of gold for more than a decade now. They've accumulated thousands of tons, particularly central banks in emerging markets and non-Western nations. Why would institutions with the power to print currency choose to hold gold? Because they understand, perhaps better than anyone, that fiat currency is ultimately a confidence game. It works beautifully when confidence remains high. But confidence isn't a constant. We've seen currency crises throughout history. We've seen hyperinflations, devaluations, competitive devaluations. The institutions responsible for managing monetary systems know the system's vulnerabilities intimately. Silver doesn't feature in central bank reserves the way gold does, but it exists in the same family of monetary metals. It has functioned as money for thousands of years, longer than any paper currency in existence. When central banks signal through their actions that precious metals matter, when they accumulate gold at unprecedented rates, they're providing information about how they view the long-term stability of the current monetary system. Are they panicking? No. Are they hedging? Absolutely. Here's something most investors don't appreciate about silver. It attracts some of the most emotional behavior in financial markets. Perhaps it's because silver is more accessible than gold, price-wise. Perhaps it's the volatility. Perhaps it's the dual nature that makes it feel like it could explode higher at any moment. Whatever the reason, silver brings out extreme psychology in both directions. When sentiment turns positive, silver buyers can become almost evangelical. They convince themselves that hyperinflation is imminent, that the dollar is about to collapse, that silver will reach triple digits within months. When sentiment turns negative, Those same investors often capitulate entirely, swearing off the metal forever, certain they've been fooled. Neither extreme serves investors well. The reality is that silver is a tool, not a religion. It's a form of savings, a portfolio diversifier, a hedge against specific risks. It's not magic, and it's not worthless. Understanding this psychological tendency is crucial, both for recognizing it in yourself and for recognizing it in the market. When everyone becomes euphoric about silver, that's often a sign that the easy money has already been made. When everyone dismisses it as a relic or a fool's errand, that's often when the structural setup is most interesting. Right now, sentiment towards silver remains relatively subdued. It's not hated, but it's not loved either. It's in that middle ground where rational analysis can actually matter. Before we go further, let's address the risks clearly, because they're real. Silver can be extraordinarily volatile. It's not uncommon to see 10, 15, even 20% moves in relatively short periods. If you're uncomfortable with that level of price fluctuation, silver probably isn't appropriate for you. The market for silver, while substantial, is smaller than many financial markets. This means it can be moved by relatively large players, creating price swings that don't necessarily reflect fundamental value. Storage and security present practical challenges. Unlike digital assets, physical silver requires physical storage. It's heavy, bulky, and needs to be kept secure. This has costs. Direct costs for storage, indirect costs for security and insurance. Counterparty risk exists if you hold silver through financial instruments rather than physical metal. Not all silver ETFs are created equal. Some hold physical metal in allocated form. Others use derivatives and unallocated positions. Know what you own. Regulatory risk is always present. Governments have restricted or even confiscated precious metals in the past, most famously with gold in the 1930s in the United States. While this seems unlikely in the current environment, it's not impossible. The industrial demand story, while compelling, isn't guaranteed. Technology changes. Substitutes can emerge. Demand can shift in unpredictable ways. And here's the biggest risk of all: you could be wrong. Every analysis, no matter how careful, contains assumptions. Markets are complex adaptive systems with countless variables. The future is fundamentally uncertain. Anyone who tells you silver is guaranteed to do anything is either misinformed or misleading you. What we can say is this: based on observable supply and demand dynamics, based on historical patterns, based on current macroeconomic conditions, there's a rational case for silver deserving attention. But deserving attention isn't the same as guaranteeing returns. If you already own silver, either physical metal or through financial instruments, this section is for you. First, clarify why you own it. Are you holding it as a monetary hedge against currency debasement, as a speculation on industrial demand growth, as portfolio diversification, as insurance against tail risk scenarios? Your answer matters because it should dictate your behavior. If silver is insurance for you, then price fluctuations are largely irrelevant. Insurance doesn't perform in the traditional sense. It either proves necessary or it doesn't. You don't cancel your homeowner's insurance because your house hasn't burned down. If silver is a speculation, you need defined parameters. What would change your thesis? At what point would you take profits? What would constitute failure? If silver is diversification, you should be rebalancing periodically, not letting it become an outsized position if it appreciates, or a forgotten position if it doesn't. Second, resist the urge to trade around a core position. Silver's volatility tempts people to try timing the swings. Sell the rallies, buy the dips, capture the oscillations. This rarely works as well as it seems it should. Transaction costs add up. Taxes on short-term gains can be substantial. Most importantly, the biggest moves in silver tend to happen very quickly. You can easily find yourself out of position when the market moves in your favor. If you believe in the long-term thesis, a core holding that you don't trade might serve you better than trying to be clever. Third, consider the physical versus paper question carefully. Physical silver provides the ultimate security. No counterparty risk, no dependence on financial system functioning, true ownership. But it comes with costs and logistics. Paper silver, ETFs, mining stocks, futures, provides liquidity and convenience. But it introduces counterparty risk and doesn't provide the same tail risk protection. Many sophisticated holders choose a hybrid approach, a physical core holding for insurance and monetary hedge purposes, and paper instruments for more tactical positions. There's no single right answer, but there is a right answer for your specific situation and objectives. Fourth, think about position sizing rationally. Silver should be a component of a diversified portfolio, not the portfolio itself. Even if you're highly convicted, concentration creates unacceptable risk. Traditional allocation models often suggest 5 to 10% of a portfolio in precious metals combined. Some prefer higher, particularly in uncertain macroeconomic environments. Some prefer lower, particularly those with higher risk tolerance elsewhere. But no serious allocation model suggests putting everything into any single asset, no matter how compelling the thesis. Finally, Prepare yourself emotionally for volatility. Silver will test your conviction. It will rally sharply and make you feel brilliant, then give back those gains and make you question everything. The investors who succeed with silver are those who establish a plan, understand their reasoning, and execute with discipline regardless of price fluctuations. If you don't currently own silver but you're considering it, approach this methodically. First, determine whether silver actually fits your financial situation. Do you have high interest debt? Pay that off first. Silver won't outperform the guaranteed return of eliminating credit card debt at 20% interest. Do you have an adequate emergency fund? Establish that first. Silver is not liquid in the way that cash in a savings account is liquid. Are you saving for short-term goals within the next year or two? Silver's volatility makes it inappropriate for short-term funds you know you'll need. Silver is for medium to long-term savings, for portfolio diversification, for hedging against specific risks. If you can't hold it for at least 3 to 5 years through potential volatility, reconsider whether it's appropriate. Second, decide between physical and paper exposure. If your goal is true monetary insurance, physical metal is the only option that delivers. But start small and learn the logistics. Buy from reputable dealers. Understand what you're paying over spot price. Arrange secure storage. If your goal is portfolio diversification and capturing price appreciation, silver ETFs offer simplicity. But research which ETF you choose. Some hold allocated physical metal. Some use derivatives. Understand the structure. Mining stocks offer leverage to silver prices, but introduce company-specific risk. Miners can mismanage operations, face political risk in the jurisdictions where they operate, or make poor capital allocation decisions. The best miners can outperform the metal significantly. The worst can lose money even as silver rises. Third, consider dollar cost averaging rather than timing an entry. Trying to buy at the bottom is appealing but rarely works. The bottom is only obvious in hindsight. Dollar cost averaging, buying a fixed dollar amount at regular intervals, regardless of price, removes the emotional element and ensures you don't put all your capital in at a temporarily unfavorable price. If you've decided to allocate 5% of your portfolio to silver, you might buy 1% per month over 5 months, or structure any variation that provides gradual entry. This approach won't capture the absolute bottom, but it protects against the worst outcomes and removes the stress of trying to time perfection. Fourth, set clear expectations. Silver is volatile. It can decline 20 or 30% from your purchase price and still be in a long-term uptrend. If you'll panic and sell during that decline, you're better off not buying in the first place. Silver may underperform other assets for extended periods. There have been decades where silver delivered essentially no real return. If you're measuring success over quarters or individual years, you'll likely be disappointed. But over very long periods, precious metals have preserved purchasing power through wars, depressions, currency crises, and monetary regime changes. Your expectations should match your timeline. Let's be direct about the errors that destroy wealth in precious metals markets. Mistake 1, excessive leverage. Some investors, excited about silver's potential, use margin, futures, or options to amplify their position. They think, if I believe in this, why not maximize returns with leverage? Because volatility kills leverage positions. Silver can easily move against you by 20% before ultimately moving in your favor by 50%. With leverage, that 20% drawdown wipes you out before you can participate in the eventual gain. Leverage transforms an investment thesis into a gambling position. Don't do it. Mistake 2, emotional trading. Silver will test your emotions constantly. It will rally and make you euphoric, tempting you to buy more at higher prices. It will decline and make you fearful, tempting you to sell at lower prices. The investors who lose money in silver aren't those who buy and hold through volatility. They're those who buy high in excitement and sell low in fear. Then repeat the pattern. Establish rules, follow them. Ignore your emotions. Mistake 3, treating silver like a lottery ticket. Silver is not going to make you rich overnight. It's not a shortcut. It's not a substitute for building skills, advancing your career, creating value in the world. It's a store of value, a portfolio component, a hedge. Treat it accordingly. Those who approach silver as a get-rich-quick scheme invariably become disillusioned and often lose money. Mistake 4, listening to extremists on either side. The silver market attracts promoters who promise the moon. Silver to 500. The banks are suppressing prices. Buy now or regret it forever. It also attracts cynics who dismiss any interest in precious metals as paranoid conspiracy thinking. Both extremes are noise. Filter them out. Make decisions based on fundamental analysis, historical context, and your specific financial situation, not on the most extreme voice in your feed. Mistake 5, neglecting other aspects of financial health. Some people become so focused on silver or precious metals generally that they neglect their human capital, their skills, their network, their health. The best investment you can make is in yourself. The best hedge against economic uncertainty is developing valuable skills, maintaining relationships, and staying physically and mentally healthy. Silver is a financial tool. It's not a philosophy. It's not an identity. Mistake 6, failing to adapt as conditions change. The thesis for owning silver today might not be valid in 5 or 10 years. Stay intellectually honest and willing to change your mind when facts change. Dogma is the enemy of good investing. We need to zoom out and look at the broader forces shaping this moment. The post-2008 world has been defined by unprecedented monetary and fiscal intervention. Central banks expanded their balance sheets massively. Interest rates went to zero, then negative in much of the developed world. Governments ran deficits that previous generations would have considered unthinkable outside of major wars. This experiment created asset price inflation without corresponding wage growth for most workers. It created wealth inequality that strains social cohesion. It created debt levels that look increasingly difficult to service without financial repression or inflation. Now, we're in a transition period. Central banks tried to normalize policy, raising interest rates to combat inflation, but the debt accumulated during the easy money era makes sustained high rates potentially destabilizing. The system is caught between the rock of inflation and the hard place of debt sustainability. In this environment, hard assets become interesting. Assets that can't be printed, diluted, or manipulated through policy decisions. Silver sits in that category, along with gold, real estate, productive businesses, and other tangible stores of value. This doesn't mean silver automatically goes up, but it does mean the conditions exist where silver's monetary properties might become more valued, even as its industrial properties face strong demand. Let's look at some historical context, because silver has been through remarkable cycles before. In 1980, silver briefly touched $50 an ounce during a speculative mania driven by the Hunt brothers' attempt to corner the market. That price, adjusted for inflation, would be well over $100 today. After that peak, silver entered a brutal bear market. By 2001, it traded below $5 an ounce, a 90% decline from the peak. Then, from 2001 to 2011, silver rallied almost tenfold, again reaching near $50. Since then, it's been range-bound, oscillating mostly between $15 and $30 with brief excursions on either side. What can we learn from this? First, silver is capable of extraordinary moves in both directions. The volatility isn't a bug, it's a feature of the asset. Second, fundamentals eventually matter, but timing is unpredictable. The setup can be compelling for years before price reflects it. Third, when silver moves, it often moves faster and further than seems rational. The industrial demand component provides a floor of sorts, but when investment demand kicks in, the floor becomes irrelevant as speculative fever takes over. Fourth, the majority of participants in silver's speculative peaks lose money because they buy late and sell in panic. History doesn't repeat, but it rhymes. Understanding previous cycles doesn't tell you what will happen next, but it does give you perspective on what's possible. There's a geopolitical element to precious metals that deserves attention. We're living through a shift in the global order. The unipolar moment that followed the Cold War is giving way to something more complex and potentially unstable. The United States remains the dominant power, but its dominance is less absolute than it was in the 1990s or early 2000s. China has risen economically and increasingly militarily. Russia, despite economic weaknesses, remains willing to challenge Western interests. Middle Eastern dynamics remain volatile. In this multipolar world, questions about reserve currencies, about sanctions, about the weaponization of the financial system become more salient. Countries looking to insulate themselves from potential financial coercion accumulate gold. They diversify away from dollar reserves. They build alternative payment systems. Silver doesn't feature prominently in this dynamic the way gold does, but it exists in the same philosophical space. It's an asset outside the traditional financial system, one that can't be frozen by executive order or sanction. For individual investors, this matters less directly, but it contributes to the broader environment where precious metals regain relevance. So, what is the detail I mentioned at the beginning? The piece most people are missing? It's the convergence. Individually, each factor we've discussed is interesting but not necessarily decisive. A supply deficit can persist for years without price impact if inventories are adequate. Industrial demand growth is compelling, but technology can shift. Investment demand can awaken, but it can also disappear quickly. Historical cheapness relative to gold is notable, but ratios can stay elevated for long periods. What makes this moment different is that all these factors are aligning simultaneously. We have a structural supply deficit that's widening, not narrowing. We have accelerating industrial demand from multiple sectors, particularly green energy. We have investment demand beginning to stir as macro conditions remind people why hard assets matter. We have historical valuation metrics suggesting silver is cheap relative to gold. We have a monetary environment characterized by unprecedented debt and currency uncertainty. Individually, these are interesting. Together, they create a setup that's genuinely unusual. This doesn't guarantee anything. Markets don't care about what should happen. But it does mean that the asymmetry might be favorable. The potential upside from current prices could be substantial, while the downside, particularly for those holding for monetary insurance rather than speculation, is more limited. That asymmetry is the detail that changes everything. Not because it makes silver a sure thing. Nothing is a sure thing.